Welcome to the Multifamily Investor Nation podcast. I'm your host, Dan Hanford. This podcast is unlike any other podcast you have been listening to. The guests on this show are true, active real estate investors closing real multifamily deals. Whether you are an active investor looking to up your game or a passive investor looking to learn more about how multifamily deals are structured, I promise you will thoroughly enjoy this podcast. So be sure to hit that subscribe button so you'll be notified of future episodes. For those of you that are interested in investing passively in these types of deals, in solid, cash-flowing multifamily deals throughout the Southeast, then visit my group, PassiveInvesting.com. Fill out the investor interest form. That's PassiveInvesting.com. If you've closed a multifamily deal in the past 12 months and want to be on this podcast, then send an email to Stacy@multifamilyinvestornation.com for details. Now let's get started.
Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And today with us, we have a very special guest, David Kamara. David, welcome back to the podcast.
Thank you so much, Whitney. It's great to be back.
Yeah. Well, before we dive into Stoney Creek, 202 units in Washington Township, Michigan, tell us a little bit about yourself, how you got into real estate, and where you're at today in the multifamily space.
Sure. So I was in management consulting for a long period of time. So after working in industry for a bit, business school, ended up in consulting, which I didn't even know existed, which was very challenging and fulfilling career, working on all kinds of fun, complex problems, mergers and acquisitions, helping companies get more efficient. But it also required a lot of travel. And my wife and I have 4 daughters, and it was just becoming not as fun for me personally to be away as much. And essentially, we were fortunate enough that we had some funds saved. I had started my own management consulting firm, and we also had invested in some single families and some duplexes early on. And looking at that business model, we said, this is a good business. It's just, we need to scale it up. And so we said, why don't we try that and see if that can result in me working less out of town and be home a bit more. And so that's what we did. We bought an apartment complex for ourselves. It went really well. We did it again, and I was still doing consulting, and I was telling my clients and my ex-colleagues about the fact that this is kind of what I'm doing, and this is my exciting plan to see less of them, tongue-in-cheek. And people actually were very encouraging and said, why don't we participate, right? We would like to maybe have some real estate exposure, and we think that you would be a person we trust to essentially invest with. Which was very humbling. And at first I said, I'm not really ready for that. Thank you. But as time went on and we stumbled upon a deal which was larger than we could do on our own. And so we went back and had those conversations with some of the folks that had volunteered, so to speak. And we set up a structure that made sense for all parties. And that's how it took off. That first deal went really well. That first deal we bought for roughly $3.6 million. We refinanced for about $8 million last year and gave everybody back all their capital, and everyone still owns equity in the deal and still continues to receive distributions, clearly. And most people rolled their original seed capital into a subsequent deal that we did. So that initial investment is now making money for folks across multiple deals, which is also cool. But that's how it started.
Are you a passive investor looking to diversify your portfolio? The team at PassiveInvesting.com is thrilled to introduce the investment opportunity of our real estate debt fund. This debt fund places first position loans on rehab projects sourced by our private lending company called Rehab Wallet. Since we started this debt fund in June of 2020, we have funded over $260 million in loans to borrowers across the United States. As a limited partner investing alongside PassiveInvesting.com, you can be part of the success of Rehab Wallet. With a minimum investment of $25,000, you can seize the opportunity to earn a preferred return of 6 to 8% with a 90-day liquidity option to call your capital back. Our real estate fund has been a great investment for our investors to have a short-term or rainy day cash reserve with a high yield return option. Don't miss out on this chance to enhance your portfolio and your financial future. Visit PassiveInvesting.com to discover more about this real estate debt fund and start your journey towards a prosperous investment today. That's PassiveInvesting.com.
That's one of the beauties of syndication. I know right now the market, we're recording this on Halloween 2023. So, the market has kind of taken a brutal beating here over the past 12 to 18 months. But, riding the market cycles, that is one of the beauties of investing in real estate and being able to extract capital, invest in multiple places, and earn returns on the same initial seed capital in multiple places. Not everything is the high roller coaster, right, guys? You got to be able to go up and down with the market. But that said, let's dive in. Okay, Stoney Creek, 202 units, Washington Township, Michigan. You closed this past summer, July, correct?
Yep.
Awesome.
Yeah.
Okay, so how did you find the deal? You and I were chatting before the show. There's an interesting story here.
Yeah, so this was an interesting one. We usually get our deals through relationships and brokers. After a while, you're in the industry, you're in the space, and whatever geography you invest in, you develop a bit of a reputation, right? So brokers will come to you and they maybe had a deal that fell out of contract and they know you can close, or they know that you can move quickly, or they know that you don't back out of deals, right? But this one is a bit different in that we had actually had a bit of a campaign of reaching out to target properties that we thought would be good acquisition targets. And so we emailed, called certain owners in the area. And so this gentleman, we actually had started reaching out to roughly 3 years ago. And property had been owned by the family essentially since the 80s. And they had run it, had done a lot with it, clearly owned it over the generations. The gentleman's in his 70s. He at first was very colorful with his words around, hey, I'm not selling this thing. Stop calling me. Don't email me. Don't mail me. Don't talk to me. I am not interested. Right?
Go away.
He was very clear about it. And truly, I don't know what ended up happening, but just thinking back on it, I think, a lot of things have happened the past 3 years, right? The pandemic happened. There was a lot of, frankly, tumult in real estate. And depending on who your tenants were, for some people, it was more difficult than others. But essentially, he came around and he said, you guys are young guys. I love giving young people a chance, relatively speaking, to, do something. And I've made my money on this. There's nothing else I can do with this asset. I'm ready to slow down a bit. So that was very welcome and we're very grateful. So it was an off-market deal and it was essentially a $17 million purchase price, right? So even kind of back of the envelope math, 3% of that is roughly $500,000 in commission. So that was good save for us and our investors. The property had kind of run its course and they hadn't reinvested in it, right? Not that they were mismanaging it, but I think the owner did not put the money back in, I guess, right? So whatever that is. So it needed roofs, it needed some windows. There's a lot of CapEx that essentially needed to happen, a lot of capital projects. And so relative to this area, it just was a tired property. And in fact, the interesting thing is there is a picture in the office of this property, circa 1980s. And it's an aerial and you can see this very long plot of land. And on both sides of it are just fields. There's just nothing around it. There's this road and then there's fields. And of course, today there's a highway on one side. There's literally brand new development complex just south of us, which is renting at $2,500. It's townhomes and with garages. It's really pretty, brand new, just built. On the north side of us is a new subdivision with, the price points for the homes is roughly $600,000. So by any stretch, it's a gentrifying area. It's an expanding area. There's a lot of growth in this area. Lots of big new houses being built. It's a good school district, right? And so a lot of families are moving there. Lots of both white collar and blue collar workers moving to this area. It's got a metro park near it. It's still about 30-minute drive to downtown Detroit. It's pretty much 30 minutes to Lake St. Clair. So a very nice general area in northern suburbs of Detroit. So the reason we had identified this in the first place was because of that, right? We knew this is a growing area. It's in Macomb County, which has a defense corridor. Macomb County is one of the counties in the country known for defense spending. So whereas most of Metro Detroit is known for automotive, I guess some people got smart and said, automotive goes through these booms and bust cycles. We need something more stable, but it's pretty much similar expertise, right? We have good mechanical engineers and good, like just engineering and manufacturing capabilities. Let's go out to a different industry. And so they picked defense. So there's actually this 6 square mile area called the Defense Corridor in Macomb County, which is like 3 miles from our property, which is known to have, like, it's the top 20 area in the country for defense spending and defense manufacturing. So that's cool. I'm just getting excited about like talking about it because I just feel like it's just a great opportunity. So back to why we targeted it in the first place, right? So the cost of new construction in this area today, post-COVID, with all the inflation increases of labor and parts, is roughly somewhere between $200,000 to $220,000 a unit. And of course, at buying this asset for $17 million, 200 units, that's roughly $85,000 a door. We do need to do a lot of repairs, which we're in the process of right now. We were able to secure great debt with a $6 million of CapEx funded. So even at $6 million divided by roughly 200 units, that's another $30,000 per door. So we'll be at about $115,000 a door. And really then the major, I guess, risk or thing we need to manage is, how well and how quickly do we get these upgrades executed? And from there, how well do we lease up? So that's kind of the challenge in the project.
Awesome. And thank you for the insight into the market and also the overarching business plan. I'm curious, what did you purchase the property for?
$17 million. Like I said, the loan we got, I think, was pretty good too, because as we started off saying too, interest rates.
Let's hold on to that because we got a whole let's get through the contract.
Sure. Go ahead.
We're skipping over 2 sections here. So the gentleman finally comes back to you. He's not telling you to bug off. He's actually like, okay, I'm ready to sell. When did he finally say he's ready to sell? Was that like
roughly April-ish of this year?
Okay.
Yeah.
And then how did you structure the contract?
Essentially, we just wrote up a contract that said we are going to purchase it from him, right? He's not going to carry back any financing. We'll get bank financing for the whole thing. We were going to put down 25%, right, of the purchase price. So roughly just over $4 million on a $17 million purchase. And again, like it was very good at that point. Like we had a very good relationship, right? We could call him up, say, hey, can we stop by the property? Just kind of get a feel for what kind of repairs we may want to do, just all informal. And of course, with all sellers, they don't want to let the tenants know that they're selling because, there's people get antsy and not sure of what to do. What does that mean for them? And so we kept it hush hush. We didn't like show up in droves, but we were able to get some good intel and insight as to what we wanted to get done.
Okay. And then did you put down any earnest money on this property?
Yes. So we put down $250 when we signed the deal, not hard until after inspections were complete. So, and then after diligence was complete, we added another $250. And at that point, it was considered earned and hard.
Okay. So did you walk all the units of the property? When did you do that? How did you do
that? So when we finally reached agreement, we kind of were able to drive by and kind of see externally and see what, maybe if there was one day can look at it. But once we went under contract, then yes, we walked all the property, all 202 units. There's 2 commercial spaces on one of the main roads leading to the property. It's a liquor store and kind of like a Mexican grocery store that also sells tacos, which is pretty cool. It has umbrellas on the side. And we go out there and get tacos sometimes when we're out there. So yes, but we walked through all of the apartments during diligence.
Was there any surprises that came up for you?
Not really. So, we kind of understood what kind of shape it was in. We knew that roofs we were going to have to replace pretty much all of them, which interestingly, we closed this on July 31st. As of today, Halloween, November 31st, we have replaced all the roofs in the property, which is, just really fast. And we kind of had a plan, which we wanted to hit before winter here in Michigan. But no, so big picture, no surprises. We knew we were going to have to spend roughly between $10,000 and $15,000 on the interiors of the units to get them to where we needed them. Vacancy was kind of fluctuating between 10 and 15% because he had some units that were in rougher shape that they just didn't have the money to go and essentially bring back to be rent ready. So we knew of those and we kind of said, that's fine because once we close, we have units to go work on without having to disturb the tenants. We essentially the CapEx plan, that the big items in the CapEx plan for us are to repair the clubhouse. There's a clubhouse, there's a pool, actually 2 pools. And then, like I said, roughly between $10,000 and $15,000 on the interiors of the units. And then windows, roofs, there's a lot of asphalt. It's a big property. So there's a lot of parking lot to repair, but that's one of the last things we'll tackle. But those kind of like are the big picture items. We were looking to do new vinyl siding, which is actually started at this point. So the exterior is being worked from the top down, roofs, fascia, soffits, gutters, siding, kind of coming down. The landscaping had not been paid as much attention to, so it looked a bit overgrown. But no, in terms of real big surprises during diligence, I would say no. We kind of knew that we're going to have to spend a lot. So it wasn't too shocking. We didn't find anything that was like, oh my God. I mean, I've walked through a lot of bad units, so I don't get frazzled too easily.
Are you a serious real estate investor looking to break into the multifamily space? Or are you an experienced multifamily investor looking to level up your game by meeting new passive investors and creating new partnerships? Have you heard of the MFINCon happening in Charlotte, North Carolina, June 12th through the 14th? The Multifamily Investor Nation Convention is a place to learn from over 60 plus high-level speakers and also to network with over 700 serious multifamily investors. If that's not enough for you, A-Rod. Yes, Alex Rodriguez, 12-time Major League Baseball All-Star with over $700 million of commercial real estate, including apartments, will be live and in person speaking at this event. Also speaking is the one and only Dr. Robert Cialdini, the godfather of influence and the award-winning author of the book Influence, one of my all-time favorite business books. Finally, we will have the CEO of Taco Bell, Mark King, joining us on stage to talk about leadership. Be sure to secure your tickets to this live in-person event as the tickets are going fast. Go to mfincon.com to find out more details. There are also sponsorship opportunities available for those of you who would like to have a booth at this event. For the details for this event and to purchase tickets, visit mfincon.com. You can use promo code MFINPodcast, all one word, MFIN Podcast, to get $200 off tickets, and that's mfincon.com. Look forward to seeing you there.
And what about the financial due diligence? You mentioned that, the occupancy was already down 10 to 15%. Were there any other surprises on financial due diligence?
Not so much as surprises as, with mom and pop owners, they often just don't have good records, right? And so we had to get the lender comfortable with the fact that his records just weren't the best, right? And so in terms of what we had to show, what we had to send to the lender were things like bank statements from the owner, right? But there wasn't any kind of very sophisticated, here's a T12, like we pretty much are helping him like use whatever he has to create a T12 in Excel and say, is this correct? And please, can we submit this, right? But mostly it was really built based on the rent roll, right? So essentially, and again, the rent roll was half handwritten, half in Excel. It wasn't the most tight rent roll by any stretch of the imagination. But the bank got comfortable with it. The bank needed estoppels for the two commercial clients just to make sure that, they were indeed paying what they were paying and that there was no defaults of any kind from their perspective. But that was it, right? So there was definitely less financial data on this deal than typically exists. And I think what made the lender comfortable was just literally the comparisons of other apartments that are renting, within a mile radius of this one, right? Like I said, there's literally a complex just south of us, like across the fence, which has much healthier unit economics. And you just literally call them up and see what they're renting for. And the bank did that. And they did that with other units, which again, some of these are not direct comps because clearly you're not comparing something built in the late 70s and 80s to 2017 construction project. But with the types of renovations we had intended and the types of financing on CapEx projects that the bank was willing to give us, they understood that delta between, a brand new thing next door and ours, which would be by any stretch of the imagination, not new, but pretty well renovated. We were predicting our rents to be somewhere in the $700 to $800 range, lower than what the newer properties were charging. And I think the lender was comfortable with that.
Got it. Well, let's talk about the lender. So you didn't do seller financing on this deal, even though it sounded like that maybe could have been an option. You opted for bank financing. How much did you finance and what were the terms of the loan?
Yeah, so I think we got a really good deal, all said, especially given the interest rate environment and the increasing Fed stance of raising rates. And the Fed met in the last week of July, and we were not sure how that was going to pan out. So we found a lend broker, right, a mortgage broker. We saw a couple of different options, but this one seemed the most, I would say, appropriate for what we were trying to do. In the past 2 years, I think we had learned that floating rate debt can get you into trouble for projects like this. And so one of the things we wanted to make sure is that even though we wanted to avoid any kind of prepayment penalties on the exit or on the refinance once the property was stabilized, we also didn't want to go into a floating rate debt loan. And so we got an 8.35% fixed interest loan on both the loan to value, which was 75%, and an additional, like I said, $6 million of funds for capital projects. So in effect, our loan was, I don't remember the exact number, right? But so 75% of 17 million is, I think, roughly 13 million and change, or just below 13 million, plus an additional $6 million for the CapEx project. So that puts us at really over 100% of the total purchase price for the loan. Naturally, the 6 million stays in escrow and you have to submit receipts for work done. They'll come out and inspect the work done. We've had an inspection already. They were extremely pleased and happy with the amount of progress we've made in such a short time. So, I mean, so far, so good. Like that first draw when you do a construction project like this is kind of always like, you're not sure how strict are they going to be? What are they going to come ask for? But again, we were very able to provide everything they wanted. They came out inspected. They're actually impressed with the pace of progress.
And what was the interest rate on that loan again?
8.35% fixed.
Fixed for how long?
It's fixed for 3 years. We have 2 options to extend for a year if we needed it. But again, the goal on our side is to get everything done within the first 2.5 years, maybe 2 years if we can, and then have a year worth of just performance to show before we go and try and refinance. And of course, we hope rates are lower in 3 years, but hey, who knows? It's a tough crystal ball on that one.
Yeah. Is there any prepayment penalty or lockout? I mean, I know that's not your business plan to fire sell the property in the next 12 months or anything like that, but...
No, so there isn't. There's no prepayment penalty. Again, it's almost essentially a bridge loan, right? So they understand that you're getting these funds to go execute the business plan and do the value add work. And when you're done, you are going to refinance it. So no prepayment penalty on this.
Well, let's talk about the balance of the loan. Did you raise capital for this deal?
Yeah, so we raised about $7 million for the deal. We actually partnered with another group out of Metro Detroit that we know. So to be transparent, they were the guys that brought us in and said, hey, why don't you partner with us on this? I mean, really good guys. They own a bundle of units around town. 3 partners that we like, respect what they've done. And we've never partnered with them before, but we felt like this deal was large enough, juicy enough that it was worth partnering on, right? We, as a rule, Cape Sierra Capital doesn't partner a ton. We like to control our own destiny, so to speak. But so we raised $7 million. And the way we structured that was each party brings in half, and each party has essentially half the controlling stake, and some slightly convoluted methods as to how you break deadlocks and voting and whatnot. But we feel like we see things very similarly in most cases, that we don't anticipate deadlock. But at the end of the day, right, if there's deadlock, then after a certain point in time, one party has to buy the other party out. And that's kind of how we structured it.
Interesting. Okay. So how did you structure this with the limited partners? Did you offer a preferred return? Are there splits? Any IRR hurdles?
Yeah. So no, is the short answer. So with Cape Sierra, the way we structure things is usually a 70-30 split with GPs, LPs, right? And we don't do preferred returns as a rule because we feel that that can serve as a disincentive in that if I'm paying a preferred return on a property that I'm doing a ton of renovation work on, that property most likely is not going to cash flow upfront, which we communicated to the investors. And if I'm paying a preferred return on something that doesn't cash flow, I'm not getting paid. And after a point in time, the GPs may lose interest in actually operating this well because essentially, right, everyone's incentives are not exactly aligned. And so we very much a stickler to, we want to align our incentives exactly with the investors, right? If the investors are losing money, we're losing money. If the investors are getting paid, we're getting paid. So no, we don't have a preferred return, and we're just a simple 30-70 split right down the middle based on equity in the deal.
And you've said it a couple of different ways. Is it 70% to the limited partner, 30% to the GP? That's
correct. Yes.
Awesome. Well, so what kind of fees did you charge the deal? Do you have an acquisition fee, asset management fee, disposition fee?
Yes. So we typically charge a 2% acquisition fee. we typically charge a 1.5% asset management fee, And on the disposition or capital event fee, we charge a 1% if at that point in time we have accomplished an average annual return to investors of at least 15% or higher, right? So essentially, if we're underperforming and we don't return a 15% average annual return, then we don't charge that disposition fee. But if we are delivering at least a 15% average annual return for each of the years we've owned the asset, we feel like we've earned a success fee, so we charge 1%. That's it. Those are the only fees we have.
Interesting. It's interesting that you base off of ARR and not IRR. So yeah, thank you for clarifying that.
Yep.
Well, I have a couple more questions for you.
Sure.
What did you find that was easy during this process that you thought was going to be a little bit more difficult? And what actually ended up being a little bit harder than you thought that you thought would be easier?
I would say that usually when you're buying a pretty big asset, which for us, this is a pretty big asset, it's not always that the relationship with the seller is quite as collegial or, simple, right? And again, I think this is just the benefit of working with sellers that are just, I guess sellers could be of any nature, but just in this case, we maybe lucked out. And the gentleman was just very easy to work with, answered questions, didn't have anything to hide. If he didn't know things, he told us, like, we don't do that, In other previous deals, it's been very sophisticated sellers who want to layer you with too many conditions and just make the thing not extremely pleasant. So in this case, it was, and it was kind of a breath of fresh air. Usually we encounter such relations on much smaller deals where, it's just a smaller owner that is not trying to kind of stick it to you at every turn, so to speak. So that was really nice. Also working with a team, right? So we're partnering with this other group. When you go and partner with a group, you never know how it's going to turn out. And frankly, that's why we don't partner much, because sometimes things don't work as smoothly as you'd like. And then you have to kind of get a consensus on decision making. In this case, again, I think that went really well. And both ourselves and the other group, I think, have similar experiences, see things in a very operational way, in a very practical way. Sometimes there's a mismatch of like capabilities and understanding of, oh, I'm the finance guy and you're like the operational guy, or vice versa. And there's not exactly an equilibrium, where in this case there was. So that's been working really well. What is more difficult? On this deal, we had something with the title company where we actually ended up having two title companies involved, which was a little bit confusing when we got towards closing, because we were emailing this person and he was on vacation, and actually he had to transfer us to this other title company, which I think was mandated by the lender or something. Ended up all working out, but it was a bit less clean than usual, I'd say. Again, both title companies were great. It's just a little bit of communication. I'm kind of nitpicking. At the end of the day, everything worked out just fine. I would say what made it complicated was the fact that I was with my family on a trip to Denali National Park in Alaska when we closed this deal. So I was literally at a campground, waking up early to catch East Coast time while I was in the West Coast, which was interesting because, it was the summer in Alaska, so you really get 20 hours of daylight anyway. And trying to go to the part of the campsite that has internet so I could wire funds and say, hey, I'm sending this early because in the next 2 days, I may not have reception where I'm at. So please confirm that you received this $3 million plus. It was quite a hoot. It was funny.
I think we've all been there, pulling over on the side of the road, balancing. For me, it's been balancing on a tree stump in the middle of a campground trying to get service. So David, thank you so much for joining us here today and sharing your knowledge and expertise. If people want to find out more about you, where can they do so?
Sure. Our website is Cape Sierra Capital. That's CAPESIERRA Capital. While you're there, you can check out a webinar that I recently put out. It's essentially capesierracapital.com/webinar. Also, there is an ebook I authored called The Personal Cash Flow Formula, and that's at capesierracapital.com/cashflow. So check those out.
Awesome. Well, again, David, thank you so much for joining us here today. And we look forward to hearing about your future deals.
Thank you so much, Whitney. It's a pleasure always being on your show. I appreciate it. Thank you.
Thank you for listening to the Multifamily Investor Nation podcast. I trust you enjoyed this episode. Take a moment right now to leave us a review and let us know what you learned. Also, don't forget to visit PassiveInvesting.com and fill out the investor interest form to invest alongside me in excellent multifamily assets located across the Southeast. That's PassiveInvesting.com. Thanks again for listening, and we'll see you on the next episode.